Thanks for joining us today on Market Call. I'm Marilla Fernandez. Martin Cobb with us on the show, Senior Vice President Equities at Lorne Steinberg Wealth Management. He'll take your questions on global and North American equities. Here's how to reach us. 1-855-326-6266 if you want to call in. You can also send an email, marketcall@bnnbloomberg.ca. Martin, good to see you. Thanks for coming in.
Hi, Marilla.
Let's talk about elevated oil prices. What do you see as a longer-term impact, since we're not sure when the oil prices are going to normalize again? And by that, I mean come down, considering the conflict.
Yeah, I mean, nobody's sure. Nobody has a clue. And it's interesting because we're seeing, interest rate expectations rise here in Canada, and the absence of rates probably in the United States. When I was a young lad, I did a white paper, one of my very first white papers, on the impact of the oil price, inflationary or deflationary. And ultimately, it's deflationary. Indeed, Bernanke in the late 1990s wrote a paper when he was at Princeton, which talked about some of the oil price shocks and how interest rates rises then led to, the recessionary environment, and perhaps we should step back from that. And I do worry that, ultimately the tax on spending that higher oil prices will inflict upon consumers ultimately will be more deflationary than the short-term headline increases in inflation we might see over the next few months.
Okay, so a little bit about that. Initially, we were all shocked by the fuel prices when we fill up gas, if energy prices go up to heat our homes, that kind of thing. But longer term, we also know supply routes are going to be affected. Food, for example, might go up because of the transport involved. So deflationary, how in the long term, just because we have less money to spend then?
Yeah, if you look at what we spend our money on, there's the discretionary stuff where we go out and do something nice and or buy something expensive, and then there's the non-discretionary stuff, food, transport, me driving down here today, and ultimately oil prices affect that latter camp much more, and we can't get away from it. If you look at central bankers, typically they worry about the inflation coming from a cost push effect going into wages. And so if we were to see wages, labour start demanding higher prices effectively, that would be more of a concern. But as we know, the labour market here is not great. It's pretty tough. So ultimately, it's a tax on spending. If you look over the longer term, you look at the previous oil price shocks, we as consumers, particularly here in Ontario, we'll be paying more at the pump, we'll be paying more for food, we'll be paying more for all the things that we can't avoid in heating our home, etc. And that will exert a more deflationary effect on the economy over the longer term.
Okay. I know, generally speaking, you take a longer term when you're when you are acting for your investors. I'm wondering if you own energy stocks right now and if you're trimming because you're benefiting from this push-up, or are you just staying the course? We
do. We own, I would say, the bellwether here, Canadian Natural Resources. We bought it last year. You never heard me talk about the oil price back then. It was the fact it's a low-cost producer with excellent capital allocation. Yes, a higher oil price would be nice icing on the cake, but we liked it for the longer term. Today, you've got to ask that question. Is it time to take a little bit of money off the table? Because this too shall pass. At some point, 6 months, a year, oil prices will be back closer to the marginal cost, which is way shy of $100 per barrel, and the stocks may give up some ground. So we don't have a huge exposure to the commodity sectors in Canada, but Canadian Natural Resources is one that we own and it's served us very well, and maybe we'll take some money off the table.
Okay, I'm sure we're going to get a lot of energy questions today. Let's take a quick break. We'll be back with Martin Cobb, Lorne Steinberg Wealth Management. Again, taking your questions today on global and North American equities. Here is how to reach us. We're back in just a moment. Welcome back. We're going to start with an email right now. It says, good afternoon. Brookfield Corporation has dropped sharply since the start of the year. I'd like your guest's opinion on why it's happening and whether this is a good time to expand my position. That email is from a viewer named Doug. What are your thoughts on why Brookfield is trending down? I mean, everything is kind of trending down, but is there a specific reason Brookfield's taking that direction?
There is. Okay. What is Brookfield Corp's largest assets under management segment? Private credit. What are we talking about today? Apart from oil prices, is private credit. Now, this is, Howard Marks and Bruce Karsh's Oaktree business. I think there's different types of private credit, but the market is concerned about everything to do with private credit, particularly those offering retail products, and you've seen redemptions being halted, etc. I don't believe Brookfield's in that camp at all. They don't tend to have the retail funds that some of the other competitors do. The thing about Brookfield is we own it. I was attracted to it in 2023 when you had the worries about commercial real estate, and the stock sold off very sharply, and we bought it at a big discount to any measure of realistic NAV. And it feels we're starting to get back to that kind of environment today because people just, with the view, like some private credit's all bad, sell the stock down.
So they're getting dragged down with everything.
Yeah, so we bought Brookfield Corp. We took some profits on it last year, and it's starting to look quite interesting again. So in terms of answering the question, yes, I do think this is an opportune time because tarred, everything's tarred with the same brush. These are high-quality operators. There's a little bit of opacity to what they do and how they make their money, which always concerns me to some extent. But risk-reward basis, Brookfield Corp is a good one for the long term. Buying it here today on the negative news.
That was for Doug. Let's move on to Bob. Bob's on the line in Bowmanville with his question. Go ahead, Bob.
Good afternoon. I'd like to ask you about Novo Nordisk. It's taken quite the hit over time here, kind of full short, but certainly long term. Your thoughts on it, or is Eli Lilly still the play in this space right now?
Are you in pharma at this point?
Yes, but just at the margin. I mean, when I started my career, pharma was the place to be. I mean, drug discoveries, the highest multiples in the market were pharma stocks. The old Glaxo Wellcomes that I used to own back then. Novo Nordisk, I'm going to put in the too hard pile. And what do I mean by that? I mean, this used to be the largest company in Europe. It was on fire, had no competition. Ozempic, we're all starting to learn about that, and it's various other drugs. There is so much competition. Yeah, Lilly is one of the competitors. They're leading the march today. There's so much competition coming from other pharma companies, and the generics are coming after this. And this is a one-trick pony. So I spent a lot of time looking at Novo Nordisk, thought it looked really interesting because it's so beaten up. But the things you just don't know the profitability it's likely to generate. If I'm in pharma, and we own likes of Johnson & Johnson, which has a big pharma business, I want to have a spread of bets, if you want to put it that way. This doesn't have that. So I don't think you have to play this category. I know what he's saying. Maybe Eli Lilly is the one to play, but there's a lot of good news baked into that price, like Novo Nordisk 3 years ago. So I would mind your eye on that, given the risks are pretty high.
So would you play this sector right now at all? Because some of them are expecting to benefit from AI and how that's going to help them move forward in drugs and prescriptions.
And it's going to help everyone. I mean, it's not good enough to just use AI. If you're the only one using it in drug discovery, great, and no one else is allowed to. That would be fantastic. But if everyone's doing it, I do think there's going to be some great drug discoveries coming from the big data analysis that AI can bring. But who's going to benefit from that? It may be us, consumers, benefit from it. Then you have politicians interfering with prices. The fact the US still spends twice as much on healthcare as the rest of the developed world, getting worse outcomes. So there's lots of pressures on these businesses. I think the good old days of pharma in the 1980s, 1990s are not coming back anytime soon.
Good to know. Let's move on to Craig in Kelowna, BC. Craig, go ahead.
And my question is about Dollarama. I've been watching it for a while. Down, I think 7% or something today. But I see on BNN's website, revenue's up, sales are up, profits are up, I mean. Any idea why it's pulled back today? And is this a good entry point? I see analysts have it at 239, 240 potentially, and the PE, I think, is around 40. So just let me know what your thoughts are if this is a good time to jump into Dollarama, if you would, please. Thank you.
The company just reported, and I guess they missed on comparable sales.
Yeah, and it was priced for perfection. We own Dollarama, and I've spoken about it, maybe even on this show in the past. It's trading on 40 times earnings not that long ago. It has retraced to the kind of mid-30s, but it's a great business. We like its position for the long term. We have allowed our weighting to scale back over time as we've had more funds coming in. We've not been adding to Dollarama, so we have been effectively reducing our position size because of valuations. When something's priced for perfection, it doesn't need to have terrible results. It just has to have results that are not particularly good or not beating expectations. So while we still like it for the long term, it's retraced now to a kind of 33, 34 times perspective multiple, which is better. But it's still a little bit rich. So it's one we may well add to, but I'm happy to sit on the sidelines for now.
When would you like it?
Well, if you look at the long-term multiple of Dollarama, and then I tend to look at the type of business, what revenue growth it can achieve, the margins, what the earnings per share growth, mid-20s multiple would be buying territory. So we are some ways away from that.
I was going to say it has some ways to go to get there. Okay, let's go to Chris then. Chris is in Delta, BC with his question. Chris, go ahead.
Thank you, Morella. Hello, Martin. Martin, first I'd like to ask if you put out any sort of newsletter or market commentary. Email-wise, I'd like to subscribe to that if you do. And then the question is on CN Rail. I know it was a top pick in one of the last few appearances of yours. It's been a core position of mine for many years now, since the beginning of my investing journey, long-term compounder. And if you look at the long-term chart, we seem to be in one of those very rare opportunity, longer-term pullback reversals from the trend. And I'm wondering if you still see CN Rail as attractive here for a long-term hold. And I will hang up and listen. Thank you so much.
I'm interested in your answer because the Kuzma question is still the big overhang for me.
Yeah, so firstly, to answer the question about, yes, you can go to our website and you can sign up for various newsletters, including our quarterly update that we give to clients and to those who are interested. So yeah, please go to our website and see what you can sign up there, and you can get some various commentaries, etc. So nothing's changed in CN Rail. I think when he mentioned I had one of my top picks prior, and the point was it's been around for 100 years. It will be around for 100 years. And there's always noise. And that noise can be wildfires, it can be bad harvest, it can be political interference, it can be labour strikes, or it can be trade negotiations with our partners to the south. And there is the potential, let's be clear, for things to go a bit pear-shaped come the summer when we sit down and try and renegotiate that. The US might walk away from it. And that would be bad news for the Canadian economy and I guess for CN Rail in the short term. But I have a long-term horizon. Find me a company in Canada with higher barriers to entry. Can't think of one. Maybe CPKC would be the only other one. So I own this for the long run. We are of the view that it will continue to grow in line with trade. It'll have a little bit of pricing power. It's very well positioned, strong balance sheet, barriers to entry, phenomenal. What's not to like? Buy it when there's noise.
When you say you hold for the long run, because you're right, there might be noise in the short term, you're talking 5-10 years beyond that?
Yeah, we owned it since we launched a Canadian dividend strategy back in early 2020. And at one point, it was our largest holding because at that point, it was very attractively valued like it is today. It then re-rated up to, it was over a 25 times prospective multiple. And we trimmed it back to a much lower weighting. And more recently, we've been adding back to it again. So we like the business in the long term. It's a bit like Dollarama, but what's the valuation? And you've heard me say it before, Morella, investors fall out of love and fall in love with stocks. So our position size reflects our level of conviction in a particular price. The business doesn't really change. Today, there's more conviction in CN Rail for the longer term, 5 to 10 years, than there would be, when it was a third higher in terms of multiple.
Let's take a quick break then. Martin Cobb, Lorne Steinberg Wealth Management, taking your questions, Global and North American Equities. Here is how to reach us. Back in a moment. Welcome back. Let's go to James on the line. He's in Montreal with a question. James, hello.
Hi. Thank you for taking my call. Yes, my question is basically, I have a concern with all the debt in the world and that debt to GDP specifically in the United States. And it's a concern in terms of the Fed's maneuverability in the future. And I was listening on how to address this in my portfolio. I was listening to one fellow, Ray Dalio. He mentioned what's of interest to me. He mentioned gold as perhaps 10% of the portfolio, which is fine. But what's interesting is he said, but not ETFs and not necessarily gold stock, bullion specifically. I'm curious if you could just tell me the advantages and disadvantages of bullion relative to this. Why is this thinking of bullion specific? And if you have some gold in your portfolio and perhaps where to buy bullion specifically. Okay, thank you very much.
Thanks, James. A very specific and good question. What is the difference between holding gold proper and holding gold stocks or ETFs?
I don't think it's as great, perhaps, as the previous correspondent he was mentioning is pointing to, because today, the gold ETFs, they may hold physical, they might not. They may just be, participating in the futures market, and can be a cost of rolling that forward, etc. But it's more plain vanilla than it used to be, and it gives individuals like me and you and our caller the opportunity to buy something that's reasonably liquid. So I wouldn't differentiate it too much. I mean, I've heard the arguments. You want to have gold. You want to have it under your mattress. You want to have gold coins. You don't want anyone to take it away from you. But I do believe we're sitting here today where some of the ETF products provide much greater liquidity and still give you that long-term gold price kind of exposure. It's interesting, there's been so much talk about the gold price, and everyone's talking about central banks buying. Central bankers have been buying about 1,000 tons of gold a year for the last 10 years. There hasn't been a big change. What has changed is speculative buying, particularly in Asia. And what have we seen of late? Asian markets, because they're so much more dependent on energy, have been selling off. There's probably a bit of a margin request or requirement for a number of these, traders, etc. So it's not surprising to me that we've seen a sell-off in Asian markets and a sell-off in gold, and maybe a move to more liquidity, more a move to the US dollar. But don't be mindful of that. That's just noise in the short term. And in terms of portfolio thinking, I think he's kind of right in terms of what he's thinking to have some exposure. Personally, I don't see much difference between ETFs and owning physical. I think it's really the differences today aren't as
You would
great.
go either way.
I think go either way. I think there's benefits and pros and cons to both.
Let's move on to Howard then. Howard is in Calgary. He's got a question. Howard, go ahead.
Thanks for taking my call. My question today is on ADP, automatic data processing. I know it's fallen precipitously since last June, and it's kind of at an all-time low or pretty close to it. Pays a good dividend, and it grows it by 10% a year. So I know most of this is because of AI fears of it taking over the business. So if I could have your opinion, please. Thank you.
Do you worry about AI in this specific case where they do this kind of data processing, which is, people rely on? And I think there's a trust issue if AI takes over. But what do you think?
The short answer is no, because this is a great example of, yes, AI is going to eat all software and all information service providers and all ADP-type businesses everywhere all at once. Think of ADP. They process your payroll for a very small cost. They have $40 billion of your money, or clients' money, sitting on their balance sheet at any one time. They transact $2.5 trillion worth of payroll processing every single year. Can someone with an AI tool, their software's not great, but someone with an AI tool come along and remove them from that? I just find that not fanciful, but a bit of a stretch. So I think we're in an environment today where there's a number of companies beyond software, that are information providers, maybe data aggregators might be at risk, where there's the baby is thrown out with the bathwater again, and I think ADP is front and center on that. It's one we own, it's one we are likely to add to, as we believe that the business hasn't changed all that much. They're enabling, in AI in their own software, but ultimately they are so entrenched. Their retention rates of customers are 99%. Why would you get rid of them? And the 1% is companies going bust. They don't lose customers typically. I think it's a great opportunity to own the stock for the next 10 or 20 years.
Do you think investors are not being discerning enough in this space then?
Absolutely. I think there's the whole ETF flow. If you look what's happening to stocks like Microsoft, who are part of the IGV ETF, money's coming out of that, everything's getting sold. I do think the whole narratives that we have today about something get so embedded so quickly. Everyone's an armchair economist. AI is going to take jobs. AI is going to kill all software. It's just too easy. And I would refute some of that argument. I think there are some businesses that are challenged, but some, like an ADP, I think are very well positioned. And the valuation, as he mentioned, is very attractive today.
That was for Howard. Let's move on to Tisha, who's calling from Vancouver Island. Tisha, go ahead.
Hi, thanks for taking my call. My question is about Stella-Jones and whether or not you would deploy new money into that company, and if you could give your perspective overall about it. Thanks very much.
Thanks for the question. Stella-Jones is construction, essentially?
Yes, they do a number of wood products. So there's the wood products. If you drive to Home Hardware,
poles.
You'll see poles. Yeah,
yes,
but
okay.
the real value-added business is in telegraph poles, plus the blocks you use on railway tracks. So there is a residential element to it, and they will be hurt by that. A client of ours asked us about Stella-Jones 2 or 3 years ago, and I looked at it, and I was very impressed by the numbers. I'm a bit of a numbers guy, but I was very impressed by the numbers in terms of how they grow their business over time, the stability of their margins, the strength of the balance sheet. Yes, there's a residential component. What you find is that investors tend to sell the stock when they worry about housing starts, and they tend to buy it when they get excited about housing starts. But if you actually look at the stuff that it provides to electricity companies, rail track, building companies, much more stable, much more high value added. So neat little small cap company, good long-term growth, valuation's okay. You buy it though when maybe there's a bit more fear possibly in housing starts, but we have quite a bit of fear today.
Let's take a quick break then. We will come back with past picks from Martin Cobb in just a moment. Time for past picks from Martin Cobb from May 27th of last year. At the time, Martin, you chose Tektronic Industries in Hong Kong. So it was 88.85 up to 105.60 now. So 19% upside and then 20% a total return. Remind us what they do and what you like about them.
Yes, because it's not in the name, is it? The clue.
It's not in the name, and it's not one of those things that you're like, oh yeah, I know what they do.
Yeah, no, and they really should change the name. So they are the world's leading power tools company. So you may have heard of Milwaukee Power Tools for the professionals, Ryobi, for the DIY enthusiasts like me. So they have really been the leader, particularly in the cordless category. So moving into cordless products. So I have a cordless lawnmower from Ryobi. So pushing that category. So they have great battery technology. They have a great relationship with Home Depot. So if you walk into you'll see the banks of green and the banks of red. And they've been taking market share from a lot of the tertiary players, but also from Stanley Black & Decker, who've had some issues. So based in Hong Kong, that's where their kind of science is done, that's where their R&D is done, but it's a US business. 70% of sales are the US. So it did great during the pandemic as we all built decks in our backyard. Had a bit of a hangover. But it's a business that typically grows, its revenues 8, 9, 10%, a little bit of margin improvement. They still make less money today than Stanley Black & Decker's power tools business does because they invest so much in R&D, 2 or 3% a year. So great little long-term grower. It's not so little anymore. I like it for the long term. Nothing's really changed.
Let's get to your next past pick. Alphabet, so Google on the NASDAQ. At the time that you picked it, it was at 172.90 US. Up to 297.35, so 72% upside, 72% total return. And I'm looking at it and thinking, okay, that was a year ago. There were a lot of tariff issues popping up. We never thought the Mag 7 would ever drag down. It has dragged down, but still Alphabet over the last year has done well. They got rid of the court case, I think, was key for them.
Yeah, right? I kind of viewed it didn't really matter. I mean, I was talking about breaking the business.
Interesting. Okay.
You break the business up because you have businesses like YouTube in there, which is the size of Netflix in terms of revenues. But what really was hurting Alphabet was the narrative of the day. Back in May of last year, AI is going to eat search.
Search, yes.
Yeah, and so AI probably is still going to eat search to some extent. But it's not going to be anything like we've seen, and they're continuing to do well on the search business. It's still growing, and they have a narrative of their own because they have now Gemini and the whole product suite. So I think it's more to do with that. But if you go back a year or so ago, the stock was trading on 16 times prospective earnings, by far the cheapest of all the Mag 7 stocks, and it was just overdone. Again, it's the same thing we're saying today with maybe like an ADP, as I was talking about earlier. There's just a point where the risk reward is too compelling. We like Alphabet. It has done very well for us. We should be probably taking a little bit of money off the table, given how well it's done because of the re-rating. But it's still a long-term grower in our view, and we still like it for the very long term. All
right, Alphabet last May, and let's get to your third pick from last year. CNQ, so Canadian Natural Resources at 43.05 to 67.57 today, 57% upside, 63% total return. Last year, oil was not doing so well. You picked the proper week to come back because clearly they're doing very, very well 3 weeks into this. However, we talked a little bit at the start of the show whether or not you would trim in a case like this one, considering they've got that push from the conflict in Iran.
Yeah, you look at the chart and you can see what's happened, and that was nothing to do with me and my prediction from last May. I liked it back then. Why did I like it? Because it's a low-cost producer. When WTI averaged $39 during the pandemic, they still had free cash flow. Great capital allocation in terms of how they pay down debt and then distribute to shareholders. Very disciplined. Ticks a lot of boxes. Nothing to do with the oil price. The oil price is the icing on the cake. Sitting here today, I try to think about what should this business earn through a cycle? And it's going to earn more this year than it will earn in a normal year. And if it gets back to some level of normal profitability, when the oil price moves back to more marginal cost, which is a long-term kind of driver of commodity prices, it'll be a little bit expensive, I think, on that basis. So it's one that we've enjoyed the benefits of what's happened. Unfortunately, what's happened in the Middle East has helped the share price, and it may be something we're mindful of. So I think in terms of viewers, just be mindful of your energy exposure because I find a lot of Canadians have a lot of money in energy, and this may be a time to take some money off the table.
Walk away with a little bit in your pocket. Okay, let's take a quick break. We will come back and take more of your phone calls in just a moment. Stay tuned. Welcome back. Charlie is on the line. He's in Montreal, and he has a question today from Martin Cobb. Charlie, go ahead.
Hi, thanks for taking my call. Martin, I'd like to know your thoughts on Amazon. I already took a position in Microsoft, and I feel that Amazon is almost as worthy as Microsoft. What's your opinion on Amazon? Thanks.
Would you pick between the two?
No, I think I'd have both of them.
Okay.
Yeah, so Amazon, I mean, different businesses. Obviously, they have the Amazon, the AWS, Amazon Web Services, which competes with Azure for Microsoft, but then you have a retail business, and then you have a kind of software business over here. So we like both today, and we've been adding to both of those stocks in our global value equity fund. Amazon is, we know that the AWS business is the leader in that. They have the retail businesses, which they didn't used to make much money in. They're now starting to make some decent money in North America, break even-ish in international businesses, but you're still seeing profitability improvement there. So whilst growth is slowing to some extent, they are seeing better growth in terms of underlying the bottom line because of improvement in margins. They're just so well positioned with they have their own kind of Netflix business, in terms of their studios, MGM, etc. The Prime, which cements you into that. So we like Amazon for the long term. So I wouldn't, buy the Mag 7 any stretch by any imagination, but Amazon's very well positioned, and the valuation today is quite appealing. It used to always be 30, 40, 50 times earnings. It's almost knocking on the door of 20-something times earnings, and the growth is still there.
Growth still there for Amazon. All right, Charlie, I hope that helps. Let's go to Mike in Vancouver. Mike, what's your question today?
Good morning. Thanks for taking my call. It's about Constellation Software. I'm a little bit confused. I just purchased it about a month to a month and a half ago, and can you explain to me why it was up $50 one day and down $100 the next? Should I keep this? Should I be patient? What's your feelings about Constellation Software?
Okay, great question, and volatile, I guess, because of the questions around that same AI theme. But what do you think moving forward, the way they work?
Yeah, when he mentions that, what comes to mind is Mr. Market. He was a character, manic depressive character, coined by Benjamin Graham. He turns up at your door every day. Sometimes he's super excited and offer you high prices for your stocks. And sometimes he's very depressed. And he'll sell you anything at any price. Mr. Market, you've got a choice in life. You can be informed by him, or you can look to take advantage of him. I'm firmly in this camp. So I would ignore the noise. Yeah, there's so much. It goes back to what we were talking about in terms of the narrative of the day. The business is positioned so well, in my view. They have something like 800 different software companies out there. They've been buying them up over the last 20 years. There's been a change in the management. I think that's unfortunate, but I don't think it really changes the roll-up strategy. Software companies are a lot cheaper in terms of buying today. So they used to pay 3 times EBITDA, maybe they're paying 2.5 times EBITDA. And as I kind of joke, they do software for cemeteries. They do software for marinas, for golf courses. I just think the barriers to entry for these businesses from AI are still pretty high. And I believe you have an opportunity today to buy Constellation at a very attractive valuation. And I struggle to find anything in Canada that's more compelling than Constellation Software today on a 5-year view. A 5-week view, I have no idea.
Mike, very clear answer on that question if you're a longer-term holder there. Richard's in Montreal. He's got a question. Richard, go ahead. Richard, are you there?
Yes, I'm here.
Go ahead.
Thank you for taking my call. I'm very concentrated in the bank, in bank stocks, especially the Royal Bank. And there's been a big swing. I know it could be a general, situation with the oil price and that. But the banks are making a tremendous amount of money, and I can't see why the stocks are having trouble to soar up a little bit. Could you clarify that for me? Thank you.
Thanks for the question.
I'll hang up.
Okay, so is this across financial sectors for the big banks? It's, a lot of Canadians think our banks are so solid, they're going to do well forever. And it's not that they're not doing well, they're just not gaining as much or as quickly as they used to, perhaps.
If you look at 2025, we all know how well technology did. Second best performing sector globally, possibly banks. Here in Canada, in the US, European banks, boy, I remember when they were dirt cheap in the European financial crisis, and today they're on valuation multiples that are up there. And it's the same with Canada. And the story hasn't changed. We operate an oligopoly in Canada. Canadian banks are much more profitable and sustain that profitability much better, say, than the US peers to some extent. That being said, it's not lost on investors today. So we've actually been trimming our Canadian banks. There's times we had 30% in Canadian banks, and then we went back to 20%, and then we went back up to 30%, because valuations lent us to do that. They're suggesting that there's better opportunities elsewhere today. So again, I hear the story, but be mindful of what you're paying for it. If it's not lost on investors that Canadian banks are very strong, but there's a price. And if you look at price to book value, which is the best measure, I believe, of a balance sheet-based business like a bank, they're up there on levels we've not seen for several years. So be mindful when he says he's concentrated in Canadian banks. Yes, I like that for the longer term, but be mindful how concentrated you are, because the market today has fallen a bit in love with some of the Canadian banks.
A little too much in love.
A little too.
It's a little too obsessed. Okay.
Yes.
Let's go to Mike in Montreal. He's got a question. Mike, go ahead.
Yeah, I thank you for taking my call. Great show as always.
Thank you.
My question is about Manulife Financial. I've doubled my money on it, so I really can't complain. I feel, though, it doesn't have the same growth as Great-West Life or Sun Life. Those stocks are up much more compared today and on an average day as well. And Manulife has also come off from its high as well. So just wondering what to do. I did sell 25% of my position at a $50 price. Thank you.
Thanks for the question.
Have a nice day.
You too. So let's talk about Life Coast. And it has dropped, as you know, but he's already doubled his money and he trimmed at 50. Would you trim some more? What would you do here?
I like Manulife. It's funny, I came to Canada in 2009, and I remember watching this show. Maybe it wasn't you, Marilla, but watching this show.
Definitely was not me.
And there were two stocks that were loathed by Canadians. One was CIBC, the accident-prone bank, and the other was Manulife, because of what it did during what came at cropper during the global financial crisis with its guaranteed variable annuities, etc. And that always piqued my interest, because hang on a sec, is Manulife unfairly viewed as the poor cousin of Sun Life? And so we own Manulife, and I think it's still a bit viewed that way. It's just not seen as being as solid and as dependable as Sun Life, and maybe not quite as exciting as Great-West Life. I think the truth is somewhere in the middle. So if you look at Manulife, yes, life companies, but really they're asset gatherers, and both them and Sun Life are asset gatherers south of the border, but increasingly in Asia as well. But it's a very tough market. So well capitalized, they've been through the problems of the past, so they've cleaned things up, so they're a bit more solid in terms of the types of business they write today. They're never going to be great growers. So maybe you can find something better to do with your money, like Constellation Software or CN Rail. But we like Manulife today as a very solid, dependable company whose valuation isn't too bad. And you compare it to the others, there's not much in it, between the businesses. So if there's a discount, it's too excessive. I'd actually prefer Manulife to the other two.
All right, on that note, we do have to take a quick break. We're going to be back with Martin Cobb for your questions in just a moment. Stay tuned. Welcome back. Philip's on the line. He's in Toronto today. Go ahead, Philip.
Station D, Ottawa, Ontario. K1P.
Philip, are you there? Okay, we seem to have lost Philip. Let's move on to Ian in Dartmouth, Nova Scotia. Ian, go ahead. Ian, are you there? Nobody wants to talk to us anymore. Okay, that's fine. Let's go to a question from Rob. Rob says, please ask your guest his thoughts on Thomson Reuters. Thomson Reuters got hit and dragged down by the questions over software as well. Different kind of business, again, where its database is its own. It's not, you can't go and grab that information somewhere else. What would you do if you held Thomson Reuters right now?
It's one of those ones I'm wrestling with. I compare it in some ways to S&P Global. I use S&P Global's Cap IQ product, and they do a number of things, and they have a number of proprietary. They have a bunch of proprietary data which I can't get anywhere else. But a lot of what they do is data aggregation, which I increasingly will be able to do somewhere else at a fraction of the price. And so I have the same fears over Thomson Reuters. Now there's the open web and the closed web. So if you're using legal products for Thomson Reuters and they're charging you $1,000 a year per seat, then it's closed web, so that large language models can't access it yet. But ultimately, will they be able to? That is the thing I wrestle with to some extent. So it's one of those I've got my eye on. We haven't pulled the trigger on Thomson Reuters 2 years ago on 50 times earnings because of this economic moat. Today it's on 20 times earnings because of the supposed lack of an economic moat. I suspect the truth is somewhere between the two. But to me, 20 times earnings is still a reasonably high multiple if you have this long-term pressure on the business. So I'm not going to sit on the fence because I think that's terrible in some ways. It's intriguing, but I'm just not convinced about Thomson Reuters yet because I do worry that the data aggregation business and the closed web part of it may become more open in time.
I'd love to talk about that more, but I want to get to the next caller. Ian has returned. He's in Nova Scotia. Ian, go ahead. Ian, are you there?
I'm here, but still talking, so can I talk?
Okay, it sounds like we missed him or he's got something else going on. He wanted to ask about Couche-Tard, which did report earnings I guess earlier in this week or late last week, I can't remember now. And they are going to get a bump up, right, from fuel prices. They run sort of gas station convenience store collaborations. What is your take on this well-known Canadian company?
Yeah, you've got to mind your eye on that because the revenues and the profits are not the same thing. So if you're a business that's retailing fuels, it's the spread that matters between the two. So if oil price goes up, your revenues might go up, but your spread might remain the same. And the flip side of that, if people are driving less, then there's less visits, to your convenience store.
Which there might be because they don't want to pay that cost of fuel. Yes.
So we like Couche-Tard, and we recently bought it back. We sold it when they made the announcement to go after Seven & I.
Yes.
Which I roll my eyes at because previously they tried to go after Carrefour, the big hypermarket chain in France, and I roll my eyes at that one. And I decided.
Why is that?
Because it's stick to your knitting. It felt like a bit of a legacy deal, both of them. Let's do something really big and chunky. And they are known for being great roll-up acquirers over time. And I've come across many management who have a great reputation acquiring businesses until they do the last one. So you think of Fred Goodwin, who was Sir Fred Goodwin at Royal Bank of Scotland. Great manager, supposedly, buying businesses until he went and tried to buy ABN AMRO, which then blew up the bank. And you see this again. It's management hubris, I guess. They like to do a legacy deal. So they're back to what they're focusing on is buying other businesses. They bought one in Europe recently from Total, embedding them, rebranding them as Circle K, and just driving the synergies. So we like the fact they're back to sticking to their knitting. So I wouldn't get too excited about the higher oil price. I think it's more of a short-term pressure on the business. But the valuation today for an entity that looks like it's got back to its knitting, to me, is very attractive. So one we've added to and may well add more to.
Sticking to the knitting. I like that.
Yeah,
okay, let's go to Bruce's email. What's your view on Air Canada stock? Is it too early to fly high? A lot going on with the airlines because the fuel prices are up, which hits their bottom line. But a lot of the airlines in the U.S. are benefiting from the higher end flyers. So what would you do here with Air Canada? Yeah, I'm not a fan on airline stocks. I grew up, there were two things to avoid. One was airline stocks, another one was France. It was a kind of rule of thumb that we had when I worked at Baillie Gifford in those days. There was a period where the airlines kind of got their act together. You saw consolidation, you saw very heightened profitability for about a decade, up really until the pandemic. They're just very high cost, operators with no control over those costs. And ultimately no control in some ways over the competition either. Competition waxes and wanes. So I just think, even today, but across most times horizons in the market, they're just better businesses to own. We like to own long-term compounders with economic moats that can drive earnings per share growth, free cash flow growth, and dividends. And I find the airlines are just not something I like to play. It's more of a lottery, and they just don't have the barriers to entry that I would like to see in a business. That was for Air Canada. Let's take a quick break. We have new top picks from Martin when we come back. Join us tomorrow for Market Call. Brendan Caldwell will be on the show, President and CEO of Caldwell Investment Management. He'll take your questions on North American large caps. Let's get to new top picks from Martin Cobb. We're going to start with Microsoft, MSFT on the NASDAQ. We've talked about quite a few of the Mag 7 today, surprisingly. You had touched on Microsoft a little earlier. Yeah. Tell me what sets them apart from some of the others. Yeah. It's funny, Microsoft wasn't that long ago, it was a $4 trillion company. Here it is today, its market cap starts with a 2, just below 3, so it's not a huge change. But the stock hasn't been a great performer over the last couple of years. I mentioned how it's probably been affected by the selling of, software stocks, ETFs, yes. And generally, and, I just think it's a bit silly, and it's an opportunity to buy one of the higher quality companies in the US, if not in the world. It's changed over the last year. I used to, ship polycarbonate discs around the world with holograms on them, and there was lots of piracy. And now it's, software as a service for a lot of the office products that we use. And then you have obviously Azure, which is the Amazon Web Services type business, where they're the number 2. So it's just solid.
They have exposure, obviously, to OpenAI, which may well be IPOing this year. I wouldn't get too excited about that because I worry about the valuation of private AI companies. But again, maybe it's a little bit of optionality in terms of that. But you look at the core business, still producing 10%-ish kind of revenue growth, a little bit of margin upside, buying back shares, even despite the fact of spending a lot of money on CapEx, it's still able to buy back shares, pay a dividend. So you're getting something like 15% earnings per share growth, and today's trading on almost 20 times next 12 months earnings. So looking at the Mag 7, marginal dollars, I mentioned Amazon, but this would be another one we'll be putting a bit of money into.
And I think they've been smart to put Copilot into its system. So everybody who uses Microsoft is just getting used to Copilot as their agent for the day.
Yes. No.
Which is great traction for them.
Yeah, they've got you trapped in there. I mean,
pretty much, right?
One thing I don't like about Microsoft is every time you're using Bing, they try and force you to stay on it. Like, stop trying to get... I don't want. But the point is, they have the seats, they have the eyeballs, and so they have a lot to lose. And let's face it, they're a fast follower. They've never been very good at being innovative.
Yeah.
Microsoft Word isn't the best word processing software out there.
But everybody knows how to use it?
Everybody knows how to use it, and we all communicate via, Outlook and stuff. So they're very well positioned. It's almost a defensive play in some ways. I'd rather own this than own consumer staples.
Yeah. Okay. Let's get to your next pick. Canadian Apartment Properties REIT, CAR.UN on the TSX. Why are you liking REITs when everybody has such a hate on for REITs right now?
I'm liking REITs because everybody's got a hate on for REITs.
Yeah.
The condo market in Canada is awful. So why would you want to buy the country's largest residential landlord with 50,000 apartments across the country? Because the condo market is awful. And there are really two aspects to that. One is what's happening with condo starts. They're collapsing. So today we're sitting here with excess supply. Prices, are falling. Rents are under pressure. And that's going to be, you're seeing a number of condo starts, condo buildings not being started.
Sure.
So what we'll be doing in 3, 4, or 5 years' time, what would the supply-demand dynamic be then? I suspect it'll be very different than it is today. In addition to that, they're trading on about 0.75 times NAV. Historically, traded about 1 times. Now, they do have some of their properties that are probably achieving above market rents, and that may well be a pressure for the next 12 months or a couple of years. But 3/4 of their portfolio is still trading, achieving rents of maybe 20% below market rents. So it's just a case of this too shall pass. This is a cycle. It's a cyclical business, and I believe we'll be in a very different position in 3 or 4 or 5 years' time. And they'll be able to have pricing power again, and they'll be trading back to par.
And you're not concerned if it goes lower in the interim period?
They're not in the downtown core. The one thing about Apt REIT is they tend to be outside the downtown core. They're not in the really hot spots. They tend to be further up the road. So they're less exposed to that kind of really hot property market. They're very good at managing the portfolio. There will be pressures for the next year or two, undoubtedly, but you're being paid the price to say 0.75 times NAV. To me, is a very attractive risk reward.
Let's get to your third pick, which is EXPN. There we go. And what do you like, EXPN LON, what do you like about this company? They're out of Ireland and essentially consumer credit reporting, you said.
Yeah, so you've heard of Equifax, and you've heard of TransUnion. Experian is actually bigger than both of them. They are the market leader in the credit bureau, consumer finance reporting to banks and other financial institutions. It's largely a B2B business. So you might get your free credit report, I might go into Credit Karma. That doesn't really matter. These guys are basically, CIBC come to them and say, look, can you tell me, should you give Martin Cobb a mortgage or not? They've got all that data. It's got things like your social insurance number. So lots of privacy, protection. Equifax had a breach, remember, several years ago. So they've been hit because of worries about AI, data aggregation. These are not the type of entities anytime soon that data will get outside and be allowed to be analysed. The stock has fallen from 27 times earnings to like 19, 20 times earnings, trading at a discount to Equifax for maybe something like 10, 12% earnings per share growth. We need these businesses. They'll be around for a long time to come.
All right. Let's leave it there. Martin Cobb, thanks as always.
Thanks, Marilla.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.